Would you buy Bitcoin government bonds? We've all heard the idea of using Bitcoin to solve the US debt crisis. It's been floating around for a while, but now with Trump officially signing the Bitcoin strategic reserve, it's starting to feel really real. On March 31st, the Bitcoin Policy Institute released a bold new policy brief. In it, they propose a brand new type of US Treasury instrument. Let me show you that. I'll open it here on my computer. It's called the Bitcoin Enhanced Treasury Bonds, BitBonds. So you can find this document on the Bitcoin Policy Institute, and they claim this hybrid structure. Let me find that on page 6. This hybrid structure could not only ease pressure on the debt market, but also trigger a significant surge in Bitcoin's price. So it's a win-win. See that here, the BitBonds framework and the 4 objectives. Reduce the interest burden on treasury bonds, expand the strategic Bitcoin reserve, create a tax advantage saving vehicle for American families, and the final goal of that, defease a substantial portion of the federal debt. So is this actually possible? And if it is, what does it mean for us as investors? Is this so-called Bitcoin bond really worth it? In this video, I'm breaking down the entire policy brief. You don't have to read the 36 pages here, so you can decide early, before anything goes live, if it's interesting for you. And I'll also show you a very clear structural flaw in the proposal that could stop it from working as intended. There's a big problem with this Bitcoin bond. We will talk about that. If you don't know me, I'm Cédric. I've been deep in the decentralized world for years, and this is the kind of breakdowns you don't want to miss, so subscribe to my channel. Add me on Telegram, that's my personal Telegram in the description box. I share stuff there that mainstream media never touches. As always. So back to the point. Technically, this is a policy brief. It starts by laying out the fiscal reality facing the US, a looming debt crisis. You know that. Over the next 3 years, more than 14 trillion in US debt needs to be refinanced. Meanwhile, interest rates are sitting around 4.5%. So that means that the US government is under pressure to roll over massive amounts of debt, while also spending more and more tax dollars just to pay interests. No one wants to hear that, especially the taxpayers. So what is the idea here with BitBonds? And how is it supposed to solve the debt problem while helping the US build, a Bitcoin reserve? That's where it gets interesting. So at its core, this Bitcoin bond is a hybrid. Bonds are hybrid. That's very important here. 90% are still traditional US Treasury, but at that you add 10% Bitcoin. And in practice for the government it's the same. 90% of investor funds go toward, regular government spending, but the remaining 10% is issued for the government to buy Bitcoin too, which gets added to the national reserve. But unlike traditional Treasury that pay 4.5% interest, BitBonds only give investor a fixed 1%, only 1% return. So is it interesting? It doesn't sound really appealing, right? That's where the Bitcoin secret mechanism enters. They added second yields from Bitcoin. If Bitcoin annual return stays under 4.5%, you will get the fixed 1% interest plus the full upside of Bitcoin's gains. But if Bitcoin's returns go over 4.5%, and a lot of people think it will, then the excess gains get split between you and the government. So for you and for the US, this structure offers major benefits if you believe in Bitcoin. First, for the government, the lower fixed interest rates, means massive savings for them, up to 70 billion a year. Second, they don't need to raise tariffs or slash spendings to deal with debt. And if Bitcoin goes on a bull run, the government, as a strategic holder, directly benefits from the price appreciation. It paints a very attractive picture. Refinance cheaply and at the same time build a Bitcoin reserve, and do all this without touching taxpayer money. And one more interesting detail is unlike a spot Bitcoin ETF where supply is still liquid, this government reserve would effectively take BTC off the market, reducing circulating supply, pumping the price. That alone could drive the price up even more, attracting new investors. So that's smart. And it really does look like a win-win on this paper. But now we have seen that it's very good for the government, the US government. But as investors, what we care about most are ROI, returns and risks. So let's look at the return side first. So they have on page 20 this figure here, figure 7. What will be the gains for you? but it's not really complete here. It's not really detailed, so I did mine, but I'll show you that. First, they say, okay, in the worst case scenario they give you here, Bitcoin will grow only 30% a year. And that will give you a total, because you have only 10% Bitcoin, remember, a total return on investment of 6.99 CAGR. How do we get to this result? I did that here. You buy $100 of BitBonds, 90 USD of US Treasury, 10 USD of Bitcoin equivalent. So at a price of, let's say, 90K for one Bitcoin is that much Bitcoin. And here is the supposed 30% per year CAGR on Bitcoin. So it will give you a price per Bitcoin from 90K to 1,240K in 10 years. So your Bitcoin value of 10 USD in 10 years would be 137 USD. So an appreciation of your Bitcoin of 127 USD. You will keep 45.3, and then after that it's all excess, and this part you will share 50-50 with the government. So this for you and same amount for the government. So you will get this threshold plus 50% of the excess. So that's 86.58 USD. And to that, of course, you will add, I could have added one column here, but it's like 1% per year guaranteed returns on the bonds. You remember the 1% annually. So your total return is L9 here, the Bitcoins plus the $10. At that, of course, I will add your original 100. That's not in the result, but that's what you have at the end. So maybe I'll have to rename this one, but that's what you have after 10 years. So your CAGR for those 10 years will be 6.99%. But that's in the case of Bitcoin going 30% per year. That's the problem here. What if they give you this table? They give you this table here, suggesting that Bitcoin will go up only, and it will go up, strongly, at least 30%, or maybe 123%. If it's 123% per year for 10 years, what will be the price of Bitcoin in 10 years? It will be 27 million in 10 years. It's possible, but it's full of hope, And in the document, at a few places, they remind you that past performance is not a guarantee of future returns, But here, they just give you really, really great prices for Bitcoin in the next 10 years, but they don't give you this price that maybe a lot of people would doubt about. They give you just CAGRs, and they don't give you the detail here. So you only have a look at Bitcoin CAGR and the possible, BitBonds CAGR in 10 years. But I think it's really, really too optimistic. What if it's only, I did here a simulation with 15%. What if it's only 10%? Or let's say just 15%. Half of the worst case scenario. At the end, you will have a CAGR of only 3.46% compared to traditional bonds that are at 4.5%. It's not that great, and that gives us a price of Bitcoin of 364,000 in 10 years. It feels low, 364,000 in 10 years. But what if they didn't give you any of the pessimistic scenario? When you have a look at their document, you don't see the possibility of getting lower returns than regular treasuries. We'll talk about that again later. There's still one thing that's really great with BitBonds. It's the tax incentive, the tax exemption, tax advantages for investors. This one is good to consider too. This proposal suggests making both the interest and the Bitcoin gains fully tax-free. No income tax, no capital gain tax. That would be a huge pull factor, especially for US investors. And that would bring a lot of people in this kind of, BitBonds. So that would pump the price. Do you understand the dilemma that I have here? Those BitBonds are really great for Bitcoin price. But if Bitcoin price doesn't go up strongly enough, it would be really a bad investment. So I really like the idea. I really like this project. I really like the Bitcoin Strategic Reserve in the US. But what they don't talk to you about, and why I wanted to do this video, is because there are risks. Of course, nothing comes without risks, but we have to speak about them. We didn't speak about inflation, for example. I gave you a preview of what would happen with the Bitcoin price, not being strong enough in the next 10 years. But we could also speak about inflation. What about inflation? If inflation runs hot, let's say 3 to 5%, and Bitcoin underperforms, your real yield could go negative. But historically, that's unlikely. And yes, since 2010, Bitcoin has averaged 215% annual returns. And even since 2020, it's averaged 52%. So their conservative 30% is quite okay, and it would compensate largely for inflation. So that 4.5% hurdle rate is pretty reasonable over the next decade. But there is still, this economic war with China, the Third World War, with Russia and Ukraine that started, in Eastern Europe and stuff like that. We have to think about all that. But still, what would be better than Bitcoin or gold as an investment to hedge against that inflation? Second risk, policy and tax risk. We have to remember that tax-free part is just a proposal. It's not law yet. If Congress doesn't pass it, or the IRS changes the rules along the way, you could face double taxation. That would hit your returns hard. Third risk, liquidity risk. The brief here says these bonds will be tradable, but early on the market will be small and the structure is complex. So if I needed to sell early, finding a buyer might be tough, and I could end up selling at a loss. So yes, you have these three risks, and the biggest flaw in the whole thing that I told you about, this bond, those BitBonds, only appeal to people who already believe in Bitcoin. If you don't trust Bitcoin, why would you lock your money into something with only a 1% guaranteed, fixed return? And if someone does believe in Bitcoin, why wouldn't it make more sense to buy traditional treasuries for the 4.5% and just buy Bitcoin separately? Why share your gains 50-50 with the US government? If you are a Bitcoin maxi, or someone who believes in Bitcoin, for me, I'd prefer to keep 100% of the upside and not share anything and not have anything to do with the government. So yes, it's a well-written proposal, but if they can't solve, those problems, it's being over-optimistic and sharing half of your Bitcoin profits with the government, I don't see a lot of people lining up to buy. Now, of course, if you are interested in Bitcoin but don't want to deal with wallets, private keys or cold storage, this could actually be a decent entry point. And if you have trust in the government, of course. It's passive exposure without the tech, overhead. But yeah, I want to ask you again. Think about it. Would you buy this Bitcoin bond? What do you think about this proposal? Drop a comment and let me know. That's it for today's video. Hope that helped you understand, what BitBonds are. Don't forget to subscribe. I'll be covering more on decentralization, crypto policies, and what's really happening behind the scenes on my channel. Yeah, thank you for watching. Merci et au revoir.